So now we're talking about a much more advanced planning technique, and this is a Cristofani trust. Now, this is not the type of trust that you want to do alone. This is going to require a tax professional, and it increases the likelihood of an audit. Okay, so what you need to do is you need to be very careful in this type of situation. Now, the Cristofani trust takes the same concepts that we applied when we talked about the annual exclusion in that video, and then the Crummey trust, where we had the Crummey withdrawal powers and we could keep it in a trust, and it expands it and tests the limits even further. So what we see when we're dealing with a Cristofani trust is basically a Crummey trust, but then what it does is it creates another classification of beneficiaries. These beneficiaries are going to be contingent beneficiaries. So what I will do in this video is I'm going to show you a visual and walk you through the process of how a Cristofani trust works. And then we're going to talk about some of the other types of restrictions that we have to be worried about because it does increase our audit likelihood. So let's go ahead and look at a Cristofani trust. So a Cristofani trust is going to take our annual exclusions and it's going to use the same concept that we're using in our Crummey trust. So if you haven't seen the Crummey trust or the annual exclusion videos, make sure you take a look at those. Now what happens is we have just extended it another level. So in this simple image, what I have is I have the person who's making the trust. We have our donor and they want to go ahead and they want to start to get money out of their estate because they're worried about that 40%. So they want to go ahead and they want to transfer it to their child. So generally, if this is a Crummey trust, what we're doing is we're giving, let's say the annual exclusion for simplicity here is $20,000. So it's actually 19 right now. Look at the year that you're watching this video to figure that out. But for simplicity, let's do 20,000. So a parent can go ahead and give their child $20,000. They give them their 30-day withdrawal window, so that way they can go ahead and they can make the withdrawal as a completed gift. All those requirements that we talked about before. And we know if the donor is married, they can do a gift split, so they could double that, so $40,000 in this situation to the child, right? So now let's look at it even further. So that would be your basic Crummey trust. So Cristofani creates this other level, and you can see all the grandchildren in here. What Cristofani does is it says, listen, I don't really want to give that money to the grandchildren. Instead, I'm going to use them as an instrumentality to help get that money to the child. So what we'll do is we'll say, listen, we're going to use these grandchildren as contingent beneficiaries. So they will only recover if the child predeceases them, if the child dies first. Otherwise, any contributions that were made to this trust for the grandchildren, for each of the grandchildren, all the proceeds will go to the child according to the terms of the trust. So the likelihood of any of the grandchildren receiving anything is extremely low, right? It's pretty low that the child will predecease or the grandchildren by the time the trust matures. So that's the direction that this is going. So now, assuming this is just a single person making the contribution, they're going to contribute $20,000 to the child, and then we have $20,000 to grandchild 1, 2, 3, 4, 5. So we have a total of 6 beneficiaries. So 6 times 20,000, and now we have 120,000 that we were able to contribute. And if our donor is married and they gift split, that's $240,000. And now what we can do is we can say, hey, what if our child has a spouse? Well, we can now make 20,000 or 40 for gift splitting for our child's spouse as well. So you can see how we can continue to add on to this thing. And if our grandchildren are married, we can include theirs. And you just kind of keep creating this thing where we're getting rid of $250,000. We could go up to $1 million, more than that if we wanted. And we're creating this trust that goes to our child. And those grandchildren, I put them in a box here because it says they're contingent beneficiaries. So it's unlikely that they're going to receive anything. Now, that's where the IRS takes real issue with it. The IRS is sitting there saying, listen, we believe in substance over form. Just because those grandchildren have a 30-day withdrawal window, we're not going to necessarily agree that they're actual beneficiaries. because it's unlikely that they're going to actually receive anything. It's all going to go to the child. So we're going to contest this, right? So this is a tension that was created, and this is what the Cristofani Trust did. Now, the courts upheld this, saying, yep, as long as they have a legitimate 30-day window to withdraw, then that's going to be fine. The grandchildren are going to apply, even if they're a contingent beneficiary. So what this case stood for was an expansion of, well, at least a test of how far we can expand who an actual beneficiary is. Now, this starts getting into areas where it increases your likelihood of being audited. So you need to make sure you have good records, and you need to make sure that you're maintaining everything on this. This is not a DIY thing. This is something that you need a tax professional, a seasoned tax professional who is accustomed to doing these types of trusts, these Cristofani trusts. So let me go ahead now and let's take a step back, because I don't want to get into any additional details. I mean, it's a Crummey trust, and it's just expanding who we have as the beneficiaries and creating a second level of contingent beneficiaries. But what I want to do now is I want to really talk about the risk management portion, because we've been talking about these different trusts and different types of gifts and the annual exclusion. Let's talk about the likelihood of an audit, so we can take a look at that. So when we're looking at doing any of this estate planning or tax planning in general, we always want to think about risk management, because audits are costly, they're time consuming, and they create a lot of uncertainty. And whether it's for us as an individual, or if you're a tax preparer or practitioner that is watching this video, you understand the level of stress that it causes our taxpayers, and that uncertainty just augments that stress. So you need to understand your client or yourself, and to determine your risk appetite. So when we're looking at things such as estate planning, gifts particularly, here's where we're looking at in terms of risk levels. So if you're giving a direct gift, there's generally a pretty low level of risk in those situations. I mean, it's pretty easy if you give somebody directly a gift and you give them $25,000, you give them $5,000, you give them whatever it is in cash, or you give them property, give them land, whatever it is. There's generally a lower level of risk. Okay, it's not as complex. It's pretty easy for the IRS to say, okay, yeah, this is what the situation is. You gave a gift. I can see the title transfer, whatever. It's fairly low risk in terms of in the likelihood of you being audited on that. Now, when you start getting to the Crummey trust, the Crummey trust isn't particularly advanced, but there is a medium risk with the Crummey trust. You're dealing with people that have to have that withdrawal power. They have to have the usually the 30-day or more withdrawal powers on that. So you start to have medium risk that it might be contested when they see something like a Crummey trust. But then when you get to the Cristofani trust, it's extremely high risk. This is where the IRS is going to really try to determine whether this was a legit type of transfer, and they may contest it, they may audit it. They're going to want to make sure, particularly, that those contingency beneficiaries are going to have that withdrawal right window. Because I'll tell you, if I were an IRS agent and I were looking at this, and I see that I have a bunch of contingent beneficiaries, and the likelihood that they're ever going to collect is 5% or less, I would be wondering, why are you not taking that $19,000 that was contributed into the Cristofani trust? Why would you not take your contribution amount right away to where you have it, right? I mean, it would make sense that you would take that instead of the small likelihood that you might get something in the future. You would generally want to take it. So that's why the IRS is going to be sitting there saying, this seems like something that's going to be form over substance, and we want to make sure there's substance over form. So when you start going into these types of techniques, make sure you have good tax representation, and that they're helping you draft this, because this is an area that could be at high risk for you in terms of audits and perhaps losing all those contributions that you made, so that annual exclusion is not actually being applied, and now it's going to be taxable, and it's going to be eating into your unified credit or whatever occurs, whether however they treat that portion of it. All right, y'all. I hope these videos are helping you. Subscribe to my channel. I'm going to continue to make some more tax planning videos. But what I will do in the meantime is I want to do some videos that are going to focus on completing tax forms and helping taxpayers that are going to be paying more immediately. But do keep an eye out. I will get back to this tax planning series, and I'll make sure that we continue to expand different tax planning techniques to help you prepare and minimize your after-tax consequences on future tax returns.